Joseph Carlson just released a recent video discussing a new stock that he has added to his portfolio. Now, for those viewers who did watch the video, they will have noticed it was MCO Moody's Corporation. He added around $5,000 to his portfolio of this company, and in today's episode we are going to analyze MCO. We're going to look and see whether or not it is undervalued and whether or not we should be considering adding it to our portfolio. We're going to run through the historical performance. We'll take a look at the revenue top line as well as the bottom line net income growth. We'll look at the health of this company, total cash versus total debt, and we'll also see how well this industry has performed as well as Moody's over the last few years. We'll analyze insider trading. We'll look at institutions if they've been buying or selling, and we'll also take a look at the dividend safety as well as the financial metrics. And as always, we will run it through our valuation model, getting to our intrinsic value as well as our acceptable price given our investor margin of safety, and see what Wall Street are expecting over the next 12 months for this company. So let's jump straight into the analysis. Now, MCO over the last year is up around 27%. It is trading towards the mid to upper end of the 52-week range. Forward PE at 37.5 with a yield of just under 1%, and we can see over the last 10 years this has been up around 394%. Bearing in mind it doesn't include those dividends reinvested, and we can see it is near its all-time highs of around $404, which it did hit at the back end of 2021. So top line revenue, we like to see 3 to 7% growth year on year. So December 2018, 4.4 billion to the top line was reported. December 22, 5.5 billion. So it has grown over the last 5 years. And what we can see on a more granular level, 2018 all the way to 2021, it had some nice growth before dropping in fact to 22 levels of 5.5 billion. And we are expecting the December 2023 annual report, when it is released, to show an increase from December 22 of 5.7 billion, although do note this is lower than the December 2021 figure. So yes, it has increased over the last 5 years, but we do know inconsistencies where it has gone up and then dropped. We will also look at the last 10 years percentage increase to the top line shortly as well. And don't forget to click on that subscribe and bell button so you are notified when Moody's releases their latest annual report and earnings, and we will run through that on the channel. So bottom line net income, 1.3 billion in 2018. December 22, 1.37 billion. So the bottom line hasn't increased that much, but again, on a more granular level, what we see, December 2018 to 2021, it has increased before then decreasing. And as we can see, it is expected again to increase in 2023, but it still isn't above even the 2020 figure. So both top line and bottom line have increased, but there are inconsistencies and they haven't continually grown. There have been some bumps along the way, and we'll analyze some of those metrics shortly in our financial metric analysis. So quick balance sheet health check, total cash versus total debt. 1.8 billion in 2018 was how much they had sitting on that balance sheet, including short-term investments. Latest quarterly report around 2.1 billion. So their cash position has increased, although very marginally. And now what's important is looking numerically and directionally to their total debt amount. And what we can see here, 5.7 billion in 2018, 7.5 billion in their latest report. So their total debt has also increased, although slightly, but still at a larger rate and faster rate than their cash. And we'll look at the net debt to EBITDA metrics soon as well. So the industry as a whole in the financial exchange and data, we're looking at companies such as CME, Intercontinental Exchange, MSCI and a few others. How have they performed over the last year? Well, MCO up 28%, in fact the second best performing when you look at the competitors. And when we look at the last 5 years, what we can see is that MCO is up 164%, again the second best performing, second in fact to MSCI. So yes, they have had a strong 5-year performance, but as always, bear in mind, past performance is never an indicator of future performance. Now very briefly, let's take a look at insider trading. Now we can see over the last 12 months around 22 million worth of sales with 0 buyers over this period. When we take a look and analyze it, we can see in fact it has been the CEO who did sell a few times in 2023, with the latest sale in terms November of 30th, 23, and he sold just under 1 million shares worth. It isn't necessarily a bearish signal, but it is something you can include in your stock analysis. Similarly, when we look at institutional ownership of the company, 90% currently, just under $6 billion worth of outflows and sales by these institutions over the last 12 months, slightly more at just under $8 billion over the same period. And when we analyze the last 4 quarters, we can in fact see in every single quarter, institutions have been buying more than selling. So again, something just to consider, but always do your own due diligence. So let's take a look at the dividend safety. So the score 83, it is very safe. Market cap just under 70 billion, a large cap company. And when we look at those recessionary metrics for those that see a recession inbound, maintain the dividend during the 07-09 crash, negative 22% recession sales, so below the average growth, but also their recession return significantly underperformed the S&P with a negative 68% return versus the S&P's negative 55%. Dividend growth, lots to love here. Double-digit increase last February, so we are expecting an increase next month. 13% increase over the last 5 years and 19% over the last 20 years. And we can see they have been increasing those dividends for the last 13 years. Now, regular viewers know we look at dividend yield theory, and it states that the company is undervalued when the current yield sits above the 5-year average. So we have a sign here of pretty reasonable valuation, 0.82% yield versus 0.89. Forward P, however, we have a sign of potential overvaluation with the forward P of 35 versus the 5-year average of 30. But as always, we're not looking at any of these models in isolation, and we will draw our conclusions towards the end. Moody's, well, the P at 35 versus the financials, it is significantly lower at 11. So let's take a look at the free cash flow. Remember, earnings susceptible to manipulation by management through accounting, so we ignore it. So free cash flow payout, we like to see below 60%. That's my personal preference. Gives me faith management can offer double-digit increases. 2022, then 43%. 2023 expected 31%. So that is positive. It is fairly low. We should be continually expecting some nice dividend increases year on year. Free cash flow payout, $4 in 2013, $6.50 in 2022. It has increased, it is positive, but again, do note the inconsistencies, which is fairly in line with our balance sheet, or in fact our income statement review. 2023, though, it is expected to increase, likewise 2024. So it is positive to note over the longer period, it is moving in the right direction, but as we can see, it isn't fast growing year on year consistently as maybe you would like. Sales growth then, 3 to 7% steady moderate growth, but interestingly for Moody's over the longer term, they have been growing at a fairly decent rate to the top line. 2020, 2021, double-digit increase, although the last 2 years haven't been the greatest. Minus 12% in 2022, 2023 is expected to be fairly flat. So something just to consider there, and look at management's guidance when they do release their latest annual report or earnings. Numerically though, they have essentially increased that top line nearly double, $3 billion in 2013, 5.5 in 22, with 5.3 or in fact 5.73 expected in 2023. They do share buybacks, not as consistently as maybe one would like, so they are returning excess cash to investor pockets. As we can see, it has reduced from 224 to 185. ROIC then, double digits is what we look for, 10% or more is my personal preference. Gives me faith management are able to effectively allocate their capital. Now, whilst this is positive, very strong figures, it is double digits, 18% over the last 2 years. One thing just to point out, it has been decreasing from 2013, so something just to keep an eye on. Hopefully this isn't a trend that will continue, but if it does start to come down year on year, it could make you worry slightly just as to where this company is going, if their ROIC is going to continually drop, especially if it goes below that 10%. Nothing much to say on the margins, absolute phenomenal, above 12% consistently on the operating side. Free cash flow margin are well above the 5% as well. Slight inconsistency some years, but over the longer period around that 30%. Very, very positive, a free cash flow machine. Finally, net debt to earnings before interest, tax, depreciation, amortization. Remember, shows us balance sheet safety as well as dividend strength. Now, these show the number of years in terms of the amount the company would need to pay off. Net of debt, Now, in terms of the number of years, 2.57, it is below the 3 that we look for. 2023, 2.15, it is coming lower, and 2024 expected to come down even more. So the company does look like to have a strong balance sheet, as well as that dividend does look to be safe based on the information we currently have. So let's jump into the valuation model. As always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. So let's jump into the first model, which is Graham's valuation model. This is one that we typically use if a company isn't fast growing, or if it isn't essentially a technological company or a REIT. Now, given the fact that Moody's has been increasing their top line double digits quite consistently, this isn't one we will be including, but it is subjective. Some people may want to, given the fact their top line has reduced over the last few years. But essentially, the intrinsic value comes to $163 with a market value of $377. It looks to be overvalued, but as I mentioned, we won't be including this, but for transparency, you did see the essential value. So the first model, we're using the multiple valuation model, companies in a similar sector and size. We have their stock price, earnings per share, P multiple. We get the average multiplied by the earnings per share of MCO to get an intrinsic value of $418, showing signs of undervaluation. We then move on to the second model, where we have the dividend discount. Very strong average growth of 11.85%, double digits every single year. We love to see this. Forward looking, we've gone 7.25%. As always, if you grab a copy of the model, if you believe it to be too high or too low, you can play around with the estimates and judgments. We get an intrinsic value of 440, undervalue signal as it is above that market value currently. We move on to the third and final model. We're using the DCF, where we have the free cash flow year on year, average growth rate per analyst estimates over the longer term. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get an intrinsic value of $315. Now, this is significantly below the market value, so we also have a sign here of overvaluation. So let's get to the intrinsic value calculator. Don't forget, if you enjoy this type of content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value 391, we can see margin of safety. 10% is what we typically use if we believe it has a wide moat, strong financial metrics, good forward-looking data. So what we're essentially saying for Moody's, we don't even see a 10% margin of safety. At 5%, it is a few dollars shy, so you could say it is itching, nearing in fact towards a 5% margin of safety. In terms of Wall Street and what they see in terms of the upside over the next 12 months, we can see again around that 5% upside. So in conclusion, we see a 5% or near a 5% margin of safety for Moody's Corporation, with Wall Street expecting only 5% upside over the next 12-month period. As always though, do let me know your thoughts in the comments below. It is important to remember, just because anyone recommends a stock or is buying a stock, whether that is Joseph Carlson or whether that is Warren Buffett, it doesn't necessarily mean you should be buying a stock. It could be used for you then to do research and do your own due diligence, but always do your own due diligence. It is very important. But let me know your thoughts in the comments below. Is this one you've added in the past, one you're looking to add, or even on the watch list? And don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or watch list. As always, have a great day. Catch you on the next episode and take care.